Something remarkable is happening in Japan's corporate world. Once known for stability, Japanese boardrooms are now buzzing with unprecedented M&A activity. Deal volumes in 2025 are hitting record highs, signaling a fundamental shift in business culture. Global financial giants like Goldman Sachs predict this momentum will only accelerate into 2026. Major industry-shaping deals are now the norm, not the exception. What's fueling this surge? At its core, a revolution in corporate finance. Japanese firms, traditionally cautious, are now embracing innovative funding methods to drive growth and global expansion. Instead of relying solely on bank debt, they're tapping into new financial tools that balance ambition with prudence. The pressure is on: deliver better returns, compete globally, and shed non-core businesses. This new dynamism is powered by sophisticated financial partnerships, bringing together diverse investors. It's a story of ambition, innovation, and the reinvention of one of the world's most important economies. Japan's M&A boom is just getting started. What's behind this M&A surge? The answer: private finance structures. Think of them as custom-built funding packages, blending equity, bank debt, and a crucial new ingredient: private credit. Long-term investors like insurance companies now provide stable capital, reducing risk for Japanese corporations. These structures are designed to protect credit ratings, allowing companies to borrow at lower costs. The result? Ambitious, large-scale buyouts are suddenly within reach. Instead of straining their own balance sheets, companies assemble syndicates of investors, private equity, insurers, and banks, who share the risk. This collaborative approach opens up new strategic possibilities. Japanese firms, once hesitant to spend their cash, now have a way to pursue bold growth without jeopardizing financial stability. Private finance structures offer a practical solution: transformational growth with managed risk. It's a sophisticated evolution, moving beyond simple debt and equity to create bespoke solutions for each deal. This is the engine driving Japan's M&A boom. The financial landscape has changed, and so has the scale of Japanese ambition. The world is watching. Let's see these new structures in action. The $7.4 billion buyout of Air Lease Corp in September 2025. Led by Sumitomo Corp's SMBC Aviation Capital, this deal aimed to create a global aviation finance powerhouse. The funding? A consortium of Japanese buyers, asset managers Apollo and Brookfield, and orchestrator Goldman Sachs. Instead of relying on traditional loans, the buyers brought in private capital, patient, long-term money from insurers and asset managers. This blend of private credit and traditional financing allowed SMBC to maintain its investment-grade rating while executing a massive acquisition. The deal was a masterclass in financial engineering, balancing ambition with stability. Its success sent ripples through the global financial community, proving that hybrid financing models can handle even the largest, most complex transactions. Since then, the pipeline for similar deals has only grown. Companies worldwide are taking note, eager to replicate this blueprint. The Air Lease Corp buyout is now a case study in modern M&A. It's not just a Japanese story, it's a global playbook for ambitious companies. The future of deal-making has arrived. For Japan's top companies, this new financial toolkit is revolutionary. It breaks the old dilemma: grow boldly or protect the balance sheet. Now, transformational M&A, deals that redefine a company's future, are possible without risking financial health. By using special purpose vehicles and bringing in equity partners and private credit, Japanese firms can share the burden of large acquisitions. This enables bold moves into new markets or technologies, while maintaining the financial conservatism ingrained in Japanese corporate culture. The result? Companies are streamlining portfolios, divesting non-core assets, and redeploying capital into higher growth opportunities. It's a virtuous cycle: focus, agility, and aggressive growth, all managed with sophisticated risk controls. Ambition and prudence are no longer at odds. They're working together. This shift is transforming Japanese business strategy. The era of strategic paralysis is over. The real engine of Japan's M&A boom, a new alliance: corporate buyers, private equity, and insurers. This isn't the old adversarial model, it's a collaborative partnership. Strategic buyers bring industry expertise and vision, but often lack the financial firepower for mega deals. Private equity firms with deep ties to insurance capital design complex financing packages and raise vast pools of patient money. Insurers, managing trillions, seek stable, long-term returns, making private credit for blue-chip acquisitions a perfect fit. Together, this trio executes deals that none could achieve alone. The partnership model is reshaping deal-making in Japan and beyond. It's less volatile than public markets, more efficient than traditional debt, and better aligned with long-term strategy. This alignment of interests is the secret sauce behind Japan's M&A surge. The future of corporate growth is collaborative. Japan's financial revolution is part of a global trend. Around the world, private capital and partnership models are transforming how major projects and acquisitions are funded. These strategies are fueling the infrastructure behind the AI revolution and the shift to renewable energy, projects needing massive patient capital. The global M&A environment is heating up, with lower interest rates and record dry powder driving transformational deals. Japan's boom reflects its unique pressures, but the tools and investors are universal. Deals like the Air Lease Corp buyout are now global case studies. Companies everywhere are learning from Japan's playbook. The world of M&A is changing, and Japan is leading the way. Japan's M&A surge isn't just about new finance. It's also about mounting internal pressure. The Tokyo Stock Exchange and activist investors are pushing companies to become more efficient and focused. Reforms target the conglomerate discount, urging firms to justify sprawling portfolios and divest non-core businesses. Activists demand sharper strategy and higher valuations, often through asset sales. The stigma around divestment is fading. It's now seen as smart strategy. This pressure is generating a steady supply of businesses for sale, fueling the M&A market. Private finance structures make it easier for buyers to acquire these assets. Governance reform and financial innovation are working hand in hand. Another catalyst is weighting tax-free corporate spin-offs. Since 2017, Japanese law allows companies to spin off divisions tax-free, but few have used it. Experts see huge untapped potential. Once a few high-profile spin-offs succeed, a wave could follow. Spin-offs let companies focus on core strengths and unlock value, eliminating the conglomerate discount. As pressure for reform grows, boards are warming to this strategy. Successful spin-offs could create new focused companies, future M&A targets or acquirers themselves. The next phase of Japan's M&A boom may be just around the corner. What's next for Japan's M&A market? Experts agree this is just the beginning. Financial innovation, governance pressure, and a new corporate mindset are driving a sustained boom. With moderating interest rates and abundant capital, conditions are ripe for more transformational deals. Japanese companies are now equipped to pursue global acquisitions and streamline at home. The pressure from regulators and activists will only intensify, fueling more activity. Private finance structures and tax-free spin-offs remain powerful underused tools. All signs point to a self-reinforcing cycle of change and dynamism. Japanese capitalism is being reinvented, more agile, shareholder-focused, and aggressive. The revolution in Japan's M&A market is just getting started.